2月21号发布的美联储1月份的会议纪要上面呢，提到了很多我们在2024年面临的经济挑战，其中呢就提到了通货膨胀可能要比我们预想的更加顽固，地缘政治的危机可能会再次打乱供应链，增加全球经济进入休克的可能性，打破刚刚恢复不久的全球供应链的同时，还很可能造成产品供给短缺，导致通胀压力激增。那自开年以来，美国金融市场欣欣向荣的景象呢，只能代表市场对今年宽松的货币政策和财政政策的预期。
Bitcoin reaching its highest level in more than 2 years after breaking above 54,000，
并不能代表我们已经走出了自疫情以来的经济波动，更不能代表我们已经躲开了经济衰退。那这一期呢，我们就由浅入深的去挖掘一下美国的经济和金融市场。那我呢，邀请到了 Real Investment Advisors 的首席投资策略官、经济学家 Lance Roberts。The
comparison to the dot-com bubble is important。
那有些朋友呢，可能会在福克斯的节目或者是一些其他的英文访谈节目里面见过他。那这次我跟他的对谈里面呢，就提到了他对通货膨胀形势的判断、牛熊周期的研究、货币供应的变化、美国的财政赤字和未来国债收益率的关系、经济结构和人口收入结构的改变和我们依然没有进入经济衰退的原因。不太擅长听英文内容的朋友们呢，也不用担心，我已经给大家翻译好了。那点开字幕呢，就可以看到。想要收藏文字版本的朋友们呢，可以点开描述栏里面的链接，我会把访谈的梗概、中文全文和一些补充内容呢发在我的 Substack 上面。还没有订阅我的 YouTube 频道和 Substack 的朋友呢，记得去订阅一下。目前呢，我 Substack 上面的内容呢还全部都是免费的。那下面呢，我们就进入正题了。First is the CPI. 3.1 came out this morning. Any comment on that? Seems like it's getting really sticky here.
It is. Look, and it's not surprising. So first of all, when we look at inflation, we have to remember two things. First of all, the Fed wants inflation. We don't want deflation. So the Fed wants inflation to grow at 2% every year. That's their target. It's going to take a while to get there. The way we measure inflation is we look at prices on a year-over-year basis. So what was the price of something last year? What was the price of it this year? If gas was $4 a gallon last year and it's $4 a gallon this year, inflation is zero. So, we want to see, or the Fed wants to see at least some rate of inflation because that correlates to economic growth. So the important thing here is to really kind of keep all this in mind. And so when we're talking about small changes to inflation from one month to the next, there's a lot of variables that go in there. There's seasonality. There's a lot of other things that happen. Interestingly, in this report, it was rents that were going up, and it was the homeowners. It was all in housing, basically, that lifted the kind of the core rate of inflation higher than expected. But again, when you take a look at what's happening in the actual data, there's a huge lag, by the way, of housing data by the time it actually gets into CPI. So, housing data on average is declining. So this is likely an anomaly that'll likely pass in the next, one or two reports, and we'll see inflation continue to come back down. But again, we could see inflation stabilize around 2.5%. That wouldn't be surprising. I still think it's going to be lower over the course of the next year, particularly if we begin to see slower economic activity. Inflation is going to be a function of economic activity. So if we begin to see inflation or the economy slow down because of the Fed, higher rates, those type of things, then inflation is going to come down with it. The one challenge that this is going to have for the markets, though, is that these higher rates of inflation means that the Fed won't be cutting as soon as the markets wanted. The markets wanted a rate cut in March. It's now maybe July. I think it's probably the latter half of the year before we see the Fed in a position to actually cut rates.
Since the CPI is kind of high, you're saying the Fed probably not going to cut rate as soon as a lot of people expected. Does it mean the stock market was too optimistic about the rate cut this year for like 5 to 7 times?
Oh, yeah, absolutely. They're too optimistic. And this is one thing we've talked about for a while is that, we came out of the gate this year, have had a fantastic run, top 5,000 on the index. Everybody's all excited. We're all buying tech stocks. And one thing we talked about is that, something will happen to kind of bring reality back into focus. And CPI just happened to be one of those catalysts of, maybe the Fed really won't cut rates 5 to 7 times this year. Maybe they were serious about 3. And so we've got to get that realignment of markets back into perspective about, the economy, Fed rate cuts, those type of things. And there's that disconnect right now. Again, we'll have to see how this goes. It's hard to pull the bullishness out of investors. When things are going up, they're very exuberant. Right now, we have a high level of exuberance all across the board. So it's going to take more than one day to break that spirit.
Yeah, seems like a lot of people are expecting this year to be a little bit more like a bull market year. One reason is election, because people don't expect a very bad market to happen in the election year. That'll make whoever that's in White House look really bad. So do you think this is a correct expectation for 2024?
Well, if you take a look at Wall Street analysts, they're always bullish. And the reason they're always bullish is because the markets are up 80% of the time, right? You just have to worry about the 20% when markets aren't up. They tend to be fairly bad years. So again, not surprising. Wall Street analysts always optimistic. They're always, pushing estimates higher every year. And so you got to have a bull market. There's always a reason that we're going to have a bull market because optimism sells. And if I'm trying to sell you a portfolio or a mutual fund or an ETF, unless I'm selling you a 3 times inverted ETF, I'm going to tell you, hey, buy this ETF because when markets go up, I'm going to beat the market or whatever it is. So look, you got to remember the media, Wall Street analysts, this is a business. The markets, Wall Street is not here to help you make money. And, advisors, everybody else is not here to help you make money. They're here to sell you product. And so you have to remember there's 2 sides of every coin is that, when you're investing, be careful of the information you're getting and make sure you understand the information that you're looking at and for whose benefit is that? Is that really for your benefit or are you being sold a product or a service at a very high premium because everybody's so excited, right? And that's, you'll do better over time, understanding that Wall Street is a business and they're trying to sell you a product.
Yeah, it's kind of interesting. I got a friend, she used to be a credit risk executive at Merrill Lynch. And then she was like, after all these years, the one that I really don't believe is the Wall Street people because they make product and then they sell the product, but they don't tell you all the secret behind it. Like, why do they pack it in that way? And that's just like you said, it's just a business, it's a product they need to sell you. It's not only finance, it's about selling. Also, since we touched on this bull market and bear market concept during your event, RIA event, you explained very well about how you define what is a bull market and what is a bear market, and this concept about secular cycle.
So yeah, it's always interesting. So last year the market was down 22%, and so everybody said, well, history says that if the markets are down 20%, that's a bear market. That was the case back in the 1980s, even in the early 1990s. That was the case because when the market was down 20%, you would have broken the previous rising trend of the market. So a 20% correction. Historically, pre-1990, a 20% correction would have changed the trajectory of prices from a positive sloping price trend to a negative one. And so that's why that's where that acronym is like 20%, that's a bear market, 20% up is a bull market, because it would actually change the price trend of the market. The problem in 2022, as an example, was that was a correction. It was not a bear market, even though the market was down 20%. And the reason is that it never broke the prevailing price trend that was bullish, this kind of 45-degree slope of prices that goes back to the financial crisis lows in 2008. We had a bear market in 2008 because when the market rolled over and we broke that rising trend line from 2003 to 2007, we were in a bear market. The market was down 50%, of course. Same thing with the dot-com crisis in 2001 and 2. So, it's very important to understand is that when we start talking about these periods of market advances and market declines, we can just throw these terms around. It's like, oh, it's a bull market, it's a bear market. It's important to remember that we're in a bull market until that bullish trend is broken. Now, that's the short term. So we can have a bear market next year. That's fine. Then there are periods of time where markets literally go nowhere over extended periods of time. And this is 10 and 20-year periods. And those are what we call secular periods. So when we talk about bull markets and bear markets, those are cyclical. Those are short-term in nature. 1 to 5 years, 1 to 3 years, 1 to 2 years, whatever it is. Those are cyclical markets. A secular period is a 10 to 20-year period where markets basically generate no return. Now, does that mean that markets are just flat for that period of time and every year is a zero rate of return? Absolutely not. Go back and look at what happened from 2000 through 2015. Markets had a 50% correction, had a 200%, 120% return, had a 50% correction, and then had to rally all the way back. And in 2015, you were basically back to where you were at the peak of the market in 1999. So from 1999 to 2015, that 16 year period, returns were zero on a buy and hold basis. Now, it didn't mean that if you were smart enough to reduce risk and avoid a lot of the downturn in 2001 and 2 and in 2008, and you were investing near market bottoms, there were great opportunities to make money and avoid risk. But for people that are kind of subscribing to a buy and hold thesis of I'm just going to buy an ETF and I'm just going to hold it, that's fine as long as we're in a secular bull period, as we are right now, that started in 2008. But when this secular period ends and we go through a period of what's called multiple contraction, that is where valuations or PE ratios are declining, during that period, returns on markets will be very near zero, if not negative.
You mentioned that the buy and hold strategy in the secular period might not work, but like from a perspective like Warren Buffett perspective, like buy and hold, he kept his stocks for like decades. So for average people, do you think that will work? It seems like it doesn't work if looking at the market at the secular period perspective.
Well, it does. Well, you got to remember, it's all about time frame and duration. So Warren Buffett's a great example. So first of all, it's kind of a misnomer that Warren Buffett holds stocks for decades. He sells stocks all the time. He's constantly swapping out, not constantly, but every year, he'll sell a company because of A, B, or C reasons, and he'll buy another company. But for Warren Buffett, he's investing other people's money. And his holding period is infinite. Because even when he dies, Berkshire Hathaway will still go on, right? So the company will go on. Well, his holding period is 100 years.
100 years.
Problem for the average person is that you only have 20 years. Most people only have about 20 years. Because, you think about, you grow up and you go to college and you graduate college and you get your first job and you're just trying to make ends meet. That's, what best you're hoping for, trying to find a place to live, pay the bills, get on your feet. You're not saving a lot of money. And then, of course, you wind up, you get married, you have a couple of kids. And so now you got to buy the house and you got to send kids to school and all these other things that occur in life. And so people don't get serious about saving and investing until maybe they're in their 40s. I tell you, I see a lot of people that come to me in their early 50s, haven't saved a penny. Like, okay, I got to start saving for retirement. That's very common. Very common. In fact, I just wrote an article on this on our website at realinvestmentadvice.com talking about, boomers and Gen Xers and a lot of the older individuals are now putting a lot more money into equity risk, trying to play catch up because they're so undersaved for retirement. So the point about secular periods for the average person is that unless you've contracted vampirism and you're going to live 100 years, you've only got 20 years to retirement on average. Let's say you're 45. You've got $300,000 saved. I'm just throwing out a number, but say you've got $300,000 saved up for retirement so far, and you're 45 years old. Say, hey, I just want to grow this pot of money so I can retire at 65. So you start this period in 1999. Well, 16 years later, you are now how old? 45 and 16. You're now, approaching your retirement. Yeah. You're approaching your retirement age of 65. And you have $300,000 still, right? Because you spent 15 years going absolutely nowhere on a buy and hold basis. So the important thing is does buy and hold investing work? Yes. And buy and hold investing does great as long as you're in a bull market. The problem is that ever since the advent of buy and hold investing in ETFs, which really came to fruition after 2008, they haven't really stood the test of time of a secular bear market period and how it affects people that are passive investing. And look, and again, I'm not bashing passive investing or anything else. I'm just saying it all depends upon your duration, your point today versus the point of actually needing your capital, and when you start on a valuation basis. So if you happen to start in a period of very high valuations that have to go through a period of reversion over time, and these cycles occur throughout history, going back to 1871, there are very distinct periods where you have long periods of time with low rates of return, long periods of time with very high rates of return. We are at the latter stages, or we're fairly long into this current cycle of extraordinarily high rates of return, which were driven by a tremendous amount of monetary liquidity from the Federal Reserve and from the government and zero interest rates. So whether or not we can sustain that indefinitely is going to be the question.
And also, I recognize that the M2 money supply since last October 2023, it did not go down. I know that the Fed has been doing the QT, but seems like M2 money supply is not going to the right direction that Fed is saying it should go. So it's been picking up. And also the inflation now is like at 3.1. Does it mean like we are possibly getting into a second wave of inflation?
It's possible. Look, there's a lot of factors that drive inflation over time, but the biggest driver of inflation is economic growth. And look, we've had a couple of very strong quarters of economic growth. So we've had a booming stock market, which increases consumer attitudes, right? Their sentiment improves when you have rising stock prices. So they go out and they spend money. That creates economic activity. And look, we had 4.9% economic growth in the third quarter, 3.3% economic growth in the fourth quarter. Looks like we're going to be tracking above 3% growth for the first quarter of this year so far. So you had very strong rates of economic growth. And this is all because of the Inflation Reduction, the money from the Inflation Reduction Act, the CHIPS Act, all kinds of other spending that's going on inside of Washington. That's all helping boost this. And so M2 as a percentage of GDP is at an extraordinarily high level. We're also running super big deficits right now, which support economic. So the bigger deficits you have, the more economic growth you have. We're spending almost $3 in debt for every dollar's worth of economic growth as of the fourth quarter. So that's why you're seeing And so you've got this strong rate of economic growth. And so the reason that inflation's being stubborn is that you've got 3% economic growth, and inflation tracks economic growth. Those are part and parcel of each other, because the economic activity is your supply and demand. Inflation is a function of supply and demand imbalances. So if you have 3% economic growth, you have 3% inflation. Interest rates should be around 3%. So interest rates are actually too high relative to the market that we're in. So interest rates are going to have to come down a bit. But if inflation stays at 3, you're going to have to keep economic growth at 3. And economic growth since the turn of the century has been about 2.2. So without further stimulus injections, in other words, if we actually, don't pass more spending bills, don't pass, big infrastructure bills, those type of things, over the next couple of years, that M2 as a percentage of GDP will decline and economic growth will slow.
Yeah, you mentioned about the fiscal policy. Basically, because this is my perspective, I believe this inflation that we just experienced, at least the first wave of inflation, largely because of the fiscal policy is like basically helicopter money, basically.
Right.
Honestly, from my perspective, I don't expect it to slow down anytime soon because there's still wars going on all around the world. Do you think this high debt circumstances will keep getting even worse? Like now it's 34 trillion, I believe. Do you think it's going to go like to 50 really fast, or you think it's going to slow down at some point? Because who's going to pay those back?
Well, the interesting thing is you take a look at Japan, right? Japan's debt GDP runs about 230%, 240%. We're at about 130. So countries can run debt for a long time, and we can print our own currency. So, as long as we can sell our debt, we can pay for it. So lots of stories in there, but yes, there's absolutely no will in Washington on the political side to stop spending money. Just as a good example, this latest, bill that was passed by the Senate, it'll go to the House here. It was originally $118 billion, $20 billion of that was for securing the border in a way. It didn't really do anything to secure the southern border of Texas, but
We know that in Texas.
yeah, exactly. So it didn't do anything, but there was 20 billion that was supposed to go to domestic uses. The rest of it was going to Israel and Ukraine and all these other things that are out there. And look, whether or not you're for funding these things or not is irrelevant. We're just spending a lot of money on other countries, and we've spent money, making sure that Ukrainian citizens' pension funds were available to them. So, we're spending money on stuff that really isn't even related to the war to help other countries, but yet we have a massive homeless problem. We've got an immigration problem. We've got cities that are trying to figure out ways to get money and housing and free healthcare to illegal, immigrants. And yet we've got citizens that don't have access to housing or healthcare or a whole variety of other things. And so there's this imbalance of what's going on, and we're running these bigger and bigger deficits, and there's really no will in Washington to stop spending money. And so, yes, the answer to your question is that, yes, the debts are going to continue to grow because we don't run a budget. And this is a very important part that people don't understand, is that when President Obama took office, that was the last budget that we had coming out of the Bush administration. Following President Obama taking office, we never ran a budget again. Every year we do what's called a continuing resolution. What a continuing resolution does, and the reason our debt is growing so rapidly, is that continuing resolutions don't line item budget any issue. So in other words, we're going to spend $100 billion on this or $10 billion on that. We have to approve all that. We just go, well, we spent $1 trillion last year, so we're going to need to spend $1 trillion this year plus 8%. So if you take a look at how the debt is increasing, it's growing at this very rapid rate because every year we're compounding that debt by 8% a year because we just add on 8% on the top of everything else that we were spending last year. So, and then on top of that, we do all this other stuff like Ukraine funding and all this. So not only do we have our budget, our continuing resolution that's just causing us to spend more and more money every year, but then we're adding other bills on top of that. So yes, the trajectory of debt is going to continue to grow because nobody in Washington wants to have a budget because they like spending money because it's what gets them elected, right? So if I can spend money, I'm going to send money to Ukraine. So everybody that supports sending money to Ukraine, they're going to vote for me because I'm funding Ukraine or Israel or, whatever it is. That's the reason politicians spend money. And they're being lobbied by corporations, by PACs and all these other things. Ross Perot back in the mid 90s was like, we've got to get rid of PACs. We've got to get corporations out of politics because it's poisoning the pool. And he was right way back then. And, it's continues to be a problem today. And this is why the interests of government don't align with the interest of the average citizen.
Corporate is just one of those beautiful, but also a negative thing for capitalism, I guess.
Yeah.
So now we become a open budget nation, basically. Right. So that means we're going to have a lot more treasury bonds being issued in the future. That leads to my next question. So if we have a lot of treasury bond being issued to the outside world, does it mean that we might have a higher bond yield in the future because it's oversupply?
Well, that's the theory. And in a vacuum, you would probably be right. Right. And if the market was left alone and it only operated based on supply and demand, how many people willing to buy something versus how many people willing to sell something, you would probably expect to see higher yields. The problem is we don't have a market that operates that way. So first of all, the U.S. is the reserve currency of the world. That's not going to change anytime soon because where else are you going to store your reserves? If you're any other nation in the world, and you're conducting transactions, 70% of all transactions around the world happen in the US dollar because it's stable, it's incredibly deep, it's liquid, and it's got the rule of law behind it. So if you're doing a transaction in a dollar, that a government's not going to come along and say, oh yeah, we're not going to honor that, right? So, so far that's, that's the stronghold of the US dollar. It is the reserve currency, and it will remain that way because there's no other alternatives. I mean, not bashing any other countries, but are you going to, if you're a nation and you've got a bunch of reserves, are you going to put it in China, or are you going to put it in Turkey? Are you going to put it in, Greece? Well, the problem with a lot of these currencies is A, they're not deep enough or liquid enough to do the type of transactions that need to be done. I mean, we're talking about trillions of dollars of transactions that get done all the time around the world. So you need a currency that's very deep, very liquid. And then with a lot of these countries, you're not really sure that one day that country's not going to go, yeah, I'm just going to keep all your money. And, if you want to come get it, right? And so that's the risk. And so as long as the US dollar remains reserve currency of the world, which it will for the foreseeable future, there's always going to be a demand for treasuries. But again, we're going to issue treasuries in advance of what these other countries will buy, because they're only going to buy what they need, right? So they'll buy what they need to store their reserves, or in the event of economic weakness or market downturn, people will buy treasuries for safety. So but there is a limited demand for that. So which means that the Federal Reserve will have to monetize all the other debt, which they will. So you're probably looking at the Federal Reserve monetizing up to 30% of all debt issuance in the future. I did a graph on this before, where the Fed's balance sheet ultimately will be $40 trillion, by 2050, versus $7 trillion now. So, you'll see a very big expansion in the Fed's balance sheet to monetize that excess debt that the Treasury has issued. But there will always be a buyer for treasuries, because we can't afford to have higher interest rates. The Fed doesn't want an economic depression. And if interest rates go up too much, you will lock down the economy, because you have so much debt. When you're talking about, since the turn of the century, we've been spending roughly about $5 of debt for every dollar's worth of economic growth. So, we're running ex debt, we're running about a negative $55 trillion economy. So, that is just a massive amount of debt that's sitting out there that has to be serviced, has to be maintained. So the Federal Reserve will monetize debt and suppress rates to keep that ball going, so to speak.
So you mentioned now we're spending like $5 for $1 economic growth. That means if the government does not have enough deficit growth, that means we may even get into some kind of deflationary scenario. So it kind of like to prevent that, it's almost like the fiscal policy has to go a little bit stronger than people expected to maintain a certain level of economic growth. Is that what it is?
Oh, yeah. No, look, you're going to have deflation at some point in the future. So, I mean, it's just, there's no way around that because of the amount of debt that we have in the system. You're going to have deflationary pressures. And so as that deflation starts to show up, this is where the Fed's going to have to really get more aggressive about monetizing debt, trying to create economic activity by getting interest rates low enough to spark consumption. So as prices come down, as you get deflation, that's where the Fed starts cutting rates back to zero to spark that economic activity, house buying, car buying, etc. If I get rates low enough, I can get you to go out and buy things. So yes, that is why the Fed will be cutting rates in order to try to ensure that they do not get deflation. Deflation is very dangerous because it's psychological. Once prices start to go down, see, prices are still going up, so that's inflation. And so we're all angry about inflation because everything just costs more. But once prices start to come down, consumers go, okay, well, that is cheaper today than it was last week. Oh, I'm going to wait a week and see if it gets a little bit cheaper. Next week, it's a little cheaper. I'll wait another week to see if it gets cheaper. And so once you start getting that psychological cycle in there of cheaper prices, deflation becomes very hard to break.
The corporation and the people who, let's say the corporation is having very expensive debt for the past 2 years.
Yes.
And also, for people who want to buy houses, they think the interest rate, the mortgage rate is too high to buy a new house. So if the Fed start lowering rate, that means the corporation will have a chance to refinance their debt. Also, people who wants to buy new houses, they will have a possibly lower mortgage rate to buy house. That means that become an inflationary pressure to the market. For maybe later this year, whenever the Fed start cutting rate. Do you think that's a correct?
Yeah, here's the first of all, that's a correct analysis, right? So as mortgage rates come down, people will go buy houses. But there's an interest, and look, I have no evidence of this, and this is strictly theoretical, right? But everybody was expecting that when we hiked rates to 7.5% on mortgages, that we'd have a big housing crash. Now, housing prices came down, but they didn't crash. And the one reason why, now supply has gone up, housing prices have come down, so that's all good. But we didn't have this big, housing is still very unaffordable because prices never really realigned with probably where they should be. And one reason for that is that people that owned homes weren't willing to sell their house to go buy a mortgage with a higher yield, a higher mortgage, to go buy another house with a higher mortgage rate, right? I'm not going to sell my house with a 3% mortgage to go buy basically the same price house with a 7.5% mortgage. Now, some people will, but most people aren't. So one of the things that we've never been in before is a situation where you've got an aging retirement group that are in homes that they would like to sell, downsize potentially, or move, closer to the grandkids or wherever it is. But they've been locked into their house because the prices really never came down far enough to jeopardize their equity ownership in their house. They were never forced to sell, trying to protect what equity they had. And then there was this issue of the mortgage rate, not wanting to take on a higher rate. So there is one scenario where we potentially have interest rates come down, and all of a sudden we get a big flood of supply hitting the market of all these existing homes that people wanted to sell. Like, oh, now's my chance to get out. I can move. I can get a 4% mortgage. We could potentially see a big supply of homes hit the market that drives prices down rather than up. Now, there's no previous period in history where we can go back and go, yeah, that's what happened before. But it's an interesting conundrum because there are a lot of people that want to sell that haven't been able to.
Right. So especially I was looking at the labor force participation rate for like boomer generation. Mm-hmm. It seems like nobody's going back to the labor market because the houses are probably getting too expensive at this moment. Right. They can just cash out and refinance to take a lot of cash so they don't have to go back to work. So sucks being 25 to 50 years old, no asset, no anything. And now probably no job because all the big tech companies. See, this is where I think is getting a little dangerous here. I was just in Seattle last week, and then one of my audience, she lives there, and she was telling me the restaurant that usually a lot of tech people go lunch for, all of a sudden become empty.
Yep.
So for this wave, is more like people are the people who earn more than average. Those group of like high earners, they are getting laid off and they are having problem with their income. But a lot of them, they probably do have a house or some sort of asset. Do you think this it's almost like you're breaking a whole structure, like demographic wise, it become weak for that slot of people?
Yeah, absolutely.
What do you think the impact that will be?
When you start talking, if you take a look at kind of demographics, right? So, you take a look at millennials, Gen Zers, they have, less wealth saved up at this point than, previous generations. They're having trouble with home ownership because of cost. They're having trouble renting because of cost. And you've got this big turn in sentiment, where, they're wanting to demand more from government versus letting capitalism do its job of how it creates wealth. So, it changes the dynamics of how the economy works. And you've got a good point, which is you take a look at labor force participation rates. There's about 100 million people in the U.S. that are missing from the rolls. We don't count them because they're have been unemployed for so long. They work multiple part-time jobs, et cetera. So we just don't even count them. They're just like, okay, they don't really want to work. They must be a student. And a lot of these people go, no, I just can't get a job. And so I'm an Uber driver. I'm a Lyft driver. I deliver for FedEx and UPS, right? I mean, they're doing it.
Talking about job. UPS.
Yeah.
UPS they just got a union deal and all of a sudden they start cutting their jobs. It's like,
yeah. Well, this is, but that's, look, and this is something that, we're going to have to come to grips with as a society, is that the reason that we outsource labor, I'm actually writing an article on this for Friday, talking about this this coming Friday, I'll have an article on this very specific thing, is that everywhere else in the world, workers work very hard. So you go to Mexico, you get a very high quality labor. They show up to work. They work very long hours. Pay is minimal. They don't ask for time off. They don't ask for a vacation. They don't want a 401k plan. They don't want health benefits. They don't want paid time off. They don't want paternity leave. They don't want maternity leave. They don't want all these different benefits that we as Americans, we're going, oh, well, if you're going to hire me, I need $25 an hour plus all this other stuff. And that's great, fine, and dandy. And, when we were a manufacturing-based society back in the 60s and 70s and 80s, that flew because we were the only country in the world. After World War II, we basically bombed out every other country. So we had to go rebuild all the manufacturing. Well, now countries like China, Vietnam, Taiwan, all these other countries, their manufacturing costs are very cheap. Manufacturing is critically important to economic growth. It has a multiplier effect of about $5 for every dollar's worth of input into manufacturing. Services have a almost negative impact. In other words, for every dollar put into services, I actually make less than a dollar back. So it has a very minimal impact on the economy. So now we went from an 80% manufacturing society to 80% services, and people wonder why their quality of life keeps coming down because we're not generating the economic activity and the prosperity across the working class. And so we keep extracting more capital from the middle class to the upper class, the upper 10% of income earners that own the businesses, right? And so, look, we have all these policies we're running around with, right? We got to fight climate change. We got to fight this. We got to fight this other thing. And if you look at the bottom of every one of these policy debates, there's a company making money off of it. Elon Musk became the richest man on earth because of climate change, right? We've got to all drive electric vehicles. And he was the guy that benefited from it. So we extracted capital from the middle class to pay for overvalued cars for Elon Musk to sell EVs. And no, you can agree with that or not in terms of the policy debate is fine, right? But you have to understand that at the end of all these policy debates, there is a group of people making money off of it. So you have to always, again, this goes back to Wall Street. What's the agenda? Who makes the money off of it? Who benefits from these things? It's great to have them. But is it benefiting the middle class? Is it benefiting the poor? Are we getting a better distribution of economic activity and economic prosperity across the population? And we're not. We're getting a bigger and bigger shift from the middle class. It's called a wealth extraction. We're extracting wealth from the middle class, shifting it up to the top 10 or 20% of income earners. And this is why everybody's so upset, right? They're upset about the quality of life. They're upset about the cost of things. But we keep moving more and more, and we keep demanding more and more of others to give to us, right? We want cheaper healthcare. We want $25 copays, which makes your insurance costs go up. You want all these things. It's fine to want them. Just understand there's a cost related to them that doesn't exist in any other part of the world. Here's a stat for you. If you make $30,000 in America, you're in the top 1% of income earners everywhere else in the world.
All right.
So we're very prosperous, head and shoulders above every other country in the world. But there is this has been a massive benefit to Americans for a very long time to be under a capitalist structure. But we're now moving it away from what capitalism used to be to corporatism, which is not beneficial to the masses. And we've got to move back away from corporatism and move back towards capitalism at some point down the road if you're going to rebalance the scales.
You mentioned about the service base and the manufacturing base of the economy. So I feel like the United States is also exporting US dollar as one of the commodity to the rest of the world. And that's kind of become a necessity to the countries outside of the United States because they need US dollar to do their business, to run their world. It's not only like the US is purposely switching to a service-based economy. It's almost like the outside world is also demanding for US dollar to get into their country and then buy their stuff. It's almost like nobody is forcing each other. It's like, oh, we all agree on this.
Well, no, we're doing that, right? So we as American citizens are doing this. What we do is we export inflation to import deflation, right? So in other words, look, we have some of the best technological skills of any planet on Earth. You go to other countries, we are light years ahead of other countries in terms of technology. But we manufacture iPhones in China,
which is cost $10, sell 1,000.
Exactly, right? But if Apple said, you know what, we're going to manufacture everything in Irvine, California, your iPhone would be 10 grand, right? Because you've got to factor in all the costs, right? I've got to pay exorbitant salaries and benefits and all these other things we just went through, right? So the reason that we have to export inflation is to import back in cheap products. We all want $299 flat screen televisions. We want cheap cars. We want cheap this, cheap that. We want cheap other stuff. I don't want to pay, but there's an impact. There's a cost for that, right? And again, you're seeing the cost of that. We want everything serviced now. We want, our groceries delivered to our house. We don't want to get off our lazy butt and go to the store anymore, right? We just want to have food delivered to our door. We want to have groceries delivered to our door. We just don't want to leave anymore. We're just going to stay home. That's fine, but those are low-cost jobs, right? Those are low-wage paying jobs. When you have strata of low-wage paying jobs, guess what you get in terms of economic activity? You get low-wage paying economics. And what we're doing is gradually driving down, because we're exporting a lot of our higher paying work to other countries to get lower costs. And so we're building a strata of lower wage paying jobs, which creates lower rates of economic demand. So we bring economic growth down. We used to grow the economy at 8% annually. We now grow at 2%. So, that's, throw debt on top of that, policies, all these other things. And look, this is why you can understand that, the younger generation, they're like, I want free student loan debt paid off. I want free college. I want free healthcare. I want, I get it, right? I get there's a cost to it. Understand there's a cost. There's nothing that's free. Somebody's got to pay for that, which means you're extracting capital from another group of people to give to you. That's fine, but there's a cost to that. And it lowers everything to the lowest potential rate of production and profitability, and gets you lower rates of economic activity and less prosperity.
Right. So there's no solution. There's only trade-offs. Depends on what you want. You pick one. And so the big question for today's interview is, why are we not in a recession? Because people talk about recession all day long for the whole 2023, and it didn't happen. So people are like, maybe it's not going to happen anymore. But just from my own research, I don't really see all the fundamental data are going to the right direction, giving like a very good economy. It's like everything is going downhill. So why are we not there yet? Is there going to be a soft landing? And like, how do we even define what is a soft landing?
So a couple of things. First of all, we have had a fairly sharp rate of economic contraction over the course of the last couple of years, right? But there's a huge difference. So prior to the pandemic, the economy was growing at about 2.5%, right? So let's just say that, I'm going to drop a ball, right? So in order to have a recession, I've got to drop the ball and it's got to hit the floor. Actually, in this case, it hits the floor. We'll say the floor is the recession line, right? So if I drop the ball from 1 foot off the table, it's gonna get to the floor pretty quick, right? So it's only got to fall 12 inches to get to the floor. So the change from economic growth to economic contraction is fairly small. Now, if I go stand on my roof and drop the ball, it's got a lot further to fall before it actually hits recession. And so if you take a look at GDP, you can see this in real time. So in GDP, we were growing at kind of a narrow band ever since 2000, roughly around 2.5%. So over the last year, the economy has contracted by about 8%. So if we had been at 2.5% growth, an 8% contraction, we would be in recession, right? But the problem is that we were growing at almost 12% nominal GDP growth. But after all that $5 trillion in stimulus and multiple checks to households and Federal Reserve bailouts and everything else, we had this massive surge in economic growth of almost 12%. So it's just taking a really long time for that ball to fall back towards recessionary territory. That's negative growth. So we're headed in that direction. It's just not getting there as fast as people thought because we were so elevated relative to where we were previously. And there's still so much money in the system. Again, CHIPS Act, Inflation Reduction Act, stimulus, all this other stuff. It's just, and I wrote an article about this talking about the pig and the python. If you just, the python, the U.S. economy swallowed this massive pig.
Oh, right.
And it's got to just work. You've seen, snakes after they eat something, there's a big ball in them, right? It's just going to take a long time for that pig to work its way through the python. We'll get there and we'll return back to normal rates of economic growth. And we could even have a recession, but we're not going to have one this year, most likely, but maybe 2025, maybe 2026. When if this monetary stimulus runs out, if we get somebody elected after the election that takes a little bit more control over spending, and we start to try to cut spending a little bit, then 2025, 2026, yeah, maybe we're in a recession.
It's interesting because I know a friend. She lives in Silicon Valley area, and then was telling me there are a lot of new companies that just design chips. And they don't really care about their revenue. How they make money is from the government. They just have a PowerPoint, whatever presentation, and turn it into to government and get the government funding. They don't even think about making a profit. So I was like, this is insane. Like how the fiscal policy is injecting all this money to business that doesn't even generate wealth.
Right. Well, no. This is the problem with all government programs. If you want truly good economic activity, you've got to get you got to get government out of stuff. Government has two jobs: national security and infrastructure. That's it. Taxes, healthcare, education, oil, you name every other department in the government. That is not their job. That all belongs to the states. And so the problem is we've gotten, government involved in everything. Why is your healthcare so expensive? Well, that's the Affordable Care Act. And so once you put another layer between the patient and the doctor, you get higher health costs. That's just the way it works. So, the CHIPS Act has now opened up a feeding frenzy for everybody to develop chips. We're going to develop our own chips in the United States. Great. So everybody runs out. The problem is there's no vetting. You don't have some private equity guys up in Washington going, yeah, that's a stupid idea. We're not funding that one. Oh, that's a good idea. We'll do that. It's just give me your PowerPoint. Oh, here's money. Go do it. So great. It creates creates some wealth for some people that are doing this over the short term, but it generates no long-term viability. It's extracting more capital from taxpayers, more debt that taxpayers have to deal with, and you don't wind up with a viable product at the end that actually creates it. Look, there's a massive difference between spending money and having what's called productive investment. There is nothing wrong with using debt, government debt, to generate productive investment. What's a productive investment? The Hoover Dam, Tennessee River Valley Authority. Now, look, I'm old, so this is stuff I know. Go look it up on Google. Google Hoover Dam. But right. We use government spending to build the Hoover Dam, which has been generating revenue for decades, right? That the government collects fees off of. So that debt's been paid for multiple times over and created a productive return. I spend $1 million, I make 10 million off of it. That's what government should be doing with debt. Unfortunately, the vast majority of debt that the government spends money on has a negative return. And so we wind up, using debt to create more debt that taxpayers have to pay.
Oh, right. The last question is, where do people find you if they want some information from you?
Sure. No. So yeah, on our website, realinvestmentadvice.com, we produce daily market commentary. These are all free. You just subscribe to them. We email you a daily market commentary. We have a weekly newsletter that goes out. Lots of market stats, statistics, how we're managing portfolios, et cetera, stock screens. So a lot of stuff to help you manage your money better. Of course, we have a YouTube channel, just like you do. And so you can find all that at our website. It's all free at the website, realinvestmentadvice.com.